What's going on, everybody? This is David Greenspan, welcoming you back to Season 4 of the Mindshare podcast. Additional podcasts are available at mindshare101.com and on all the major podcast platforms. This week's episode is sponsored by Kit's Keep in Touch Systems, as well as our friends at the Buzz Conference. Now, make sure you mark your calendars right now for Disruption 2022, taking place on September 7th and 8th, located at the Liberty Grand in Toronto, Ontario. It is sure to be another incredible event being put on by the Buzz. Now, be sure to follow them on Instagram at the Buzz Conference. Make sure to give them a visit online at www.thebuzzconference.com. Keep up to date with everything they're up to. Check out the latest events. Grab your latest copy of the Buzz Digital Magazine. And of course, we're very grateful to have the Buzz Conference as an ongoing sponsor of the Mindshare podcast. Kits is also with us. Kits is always with us. And hey, just always coming up with new tools, new tricks, new ways to help you get out and build that Mindshare. We've got a brand new email feature, which is just loaded with value. It's got some amazing click-through links, making it really, really easy to deliver a ton of content and, well, again, get a lot of value out to your audience. Of course, just one of the many tools that Kits is offering as part of the entire cross-channel marketing platform for you. So I want to encourage you guys, go over to mindshare101.com, click on marketing, learn about this powerful system. It has got everything you need from a marketing tool set to help you get out there and grow your business. Again, mindshare101.com/marketing. Now, as you know, we are on a push to get to 100 reviews on iTunes, and I'd like to ask you, if you haven't yet, please take 2 minutes to rate the show. Leave us a big 5 stars. Give us a nice little review. Tell us how much you love it. Super, super easy. All you have to do is go to ratethispodcast.com/mindshare101. As always, thank you in advance. Today's episode is number 191. He is the founder at Gauvreau Accounting, Tax, Law, and Advisory, one of North America's leading CPA firms working exclusively with entrepreneurs, owner-managers, and investors to help them achieve accelerated income and wealth accumulation. He is also the founder of the high-performance coaching program, The $1 Million Year for Entrepreneurs, and is an avid investor in commercial real estate projects with a real estate investment portfolio surpassing $50 million. As one of North America's leading business finance experts, he is one of the youngest fellows to ever be admitted into membership at CPA Canada and is a regular contributing expert in a major business magazines such as Forbes, Entrepreneur, Business Advantage, and Canadian SME. And he and his team have been recognized as one of the fastest growing companies in Canada, according to the Global Mail, and in the Americas, according to the Financial Times. The best-selling author of The Wealthy Entrepreneur, The Formula for Making Money and Gaining Financial Clarity in Your Business, has recently partnered with Grant Cardone to offer his industry-leading 10X sales and marketing trainings as a licensed 10X expert. And he's on a mission to positively influence the financial performance of 1 million small businesses and investors across North America. Joining me on this episode of the Mindshare podcast is founder and CEO of Gauvreau CPA, Mr. Robert Gauvreau. Robert, welcome to the Mindshare podcast.
Hey, great to be here.
Hey, thank you, man. Appreciate the time. And as you're on a mission to help positively influence the financial performance of 1 million small businesses, we're excited to have you here today. We are excited to help you sort of accomplish that mission by providing an audience that I know is about to soak up a whole bunch of amazing knowledge. Because, you know, you and I had the opportunity to meet at the multifamily conference where we shared a stage together, and I was able to listen to your talk. And one of the big things that came up, which we'll dabble into, we won't start on today, but one of the big things that came up is I kept hearing you talk about, like, I don't know how you worded it, but kind of beating the tax man. And I thought, I like this guy. How's it going today, man?
Probably some nerd language, right?
There was something going on, but all I was able to see was he's going to help me save on taxes.
Absolutely. Yeah.
Which is a big one, man. But no, seriously, as we watch inflation rise, interest rates climb, the real estate market go down, business and real estate is slowing from the frenzied past couple years that it's been, and it's leaving a lot of agents, you know, worrying about where the next deal is coming from. And many are having listings that are being taken off the market because sellers are not getting what they expected. What advice would you have for agents in what they could or should be discussing with their clients when it comes to financing in this new market?
Yeah, and what I will say is I spent a full day yesterday with Royal Bank and a few of their vice presidents of commercial banking. And I think Royal Bank came out yesterday and said that they expect that there's going to be a 17% downward price adjustment on residential real estate. So I thought that was really interesting. And it's like, you know what? We have so much fear of the unknown. Let's take that. Let's take a little bit of economic understanding and say, okay, we are going to realize some downward trend in value, which means some people may not be wanting to sell. That's a challenge, right? Especially if we're looking to sell real estate. But what I would say on the other side, the upwards pressure of interest rates might be causing enough fear with existing owners right now that they will be looking at selling. And, the interest rates, it's funny, my wife and I kind of joke about it. We bought our first home in 2006 and our mortgage rate was 5.85%. And look, we're still here, right? It's one of those things. We survived it. We bought, we've continued to acquire more real estate along the go. But what I would say to those realtors, how we could maybe address the interest rate is, for those potential investors or buyers that are out there, get your money ready, get it lined up, get your pre-approvals ready, because the game's changing a little bit. There aren't going to be as many potential buyers out there because they weren't pre-approved and interest rates are a little bit scarier. So I would, if I had a buyer list, I would say, let's go get pre-approved. There's going to be less competition, likely less, bidding over value. And let's use the fact that interest rates are scaring people to our advantage. And let's go buy some properties at a 17% reduced investment value.
It's interesting. I mean, as you bring up from, 06 and 07 and 08 and back then, and I mean, where the rates were then versus where they've been over the past few years and to where they're going. You're absolutely, I mean, it's a great point that you bring up, right? We're still here. The one thing we're not seeing is we're not seeing these things creeping into the double digits, which we saw in the late 80s or early 90s. So again, I think that there's a lot of affordability out there, much the same too. And it's the same thing I've cautioned a lot of our clients of the agents, the brokers, be sure that you're also thinking about 3 to 5 years down the road. Because that we don't know where rates are going to be at the time. If they are higher, I mean, one thing to note is that money's not getting any cheaper. So now is the time to make the move if you're going to do it. Much the same in 3 to 5 years. We want to ensure that anything we do today is not going to set somebody up for failure in 3 to 5 years from now.
Yeah.
The other thing that I picked out on that was
David,
sorry, go ahead.
Can I throw one more piece in there? One of the things that we talk a lot about is, okay, interest rates are going up. And we're going to be renewing maybe our mortgage if you've got an existing buyer or you've got a potential buyer worried about where interest rates are going to go. Everybody has to kind of take a step back. And this is maybe a good perspective for agents to talk to their buyers about, to kind of calm them down about what the future looks like. We can always extend our repayment period, right? Everybody's so worried about, paying this down as fast as possible. But if interest rates go up, we can still manage our payment at the exact same amount if we extend it over maybe an extra couple years. So there are manageable ways that, it's not something we all need to be fearful of. We just need to essentially manage our cash flow that's going out in a certain way. So if we can't adjust interest rates back down, well, we can adjust our payments and extend it out over a couple periods of time. Yes, maybe it's a short-term plan, while we continue to work on getting our income up. But this is another opportunity to help manage our cash flow. And one of the things I would say, whenever we're talking with any real estate agents or business owners about purchasing vehicles or anything, it's always, let's extend that period out over the longest possible period of time. Instead of forcing ourselves into paying down our principal home, let's use the cash flow that we have. Instead of it going to debt repayment, let's get that ready for income producing assets. So that might be a follow-up sale to say, not only should you be buying now, but you should be looking at investment properties as well, because maybe in the first time in 5 to 10 years, there could be a surplus of investment properties that are coming available. So let's get our cash ready, because there's more money to be made than we've ever seen coming up in the next 5 years.
I told you guys all, when it comes to making money and saving money, he's going to help us out on this one today. So I like that. Now, You also mentioned about RBC talking about, prices dropping by 17%. I want to clarify that right now. And I know the agents understand this one. But for everybody that's tuned in, it's very important to understand, I'd like to understand 17% since when? Because we're looking back to January, February of this year. We were at the peak of our market. And realistically speaking, we're just really going to go back to maybe where we were at about this time frame last year, which again is still way up. There's a ton of equity out there for people. So we are still in a great market. And I just want everybody to understand we are not in a bad market. It might be tougher to do business. The more communication, the more education you do, the more opportunity you're going to create. Now, Bob, as we look at direct advice for our realtor audience, they own their own businesses. We're talking about small business entrepreneurs. Curious, should agents even be thinking twice about opening a PREC, the Personal Real Estate Corporation? I mean, yes, no, why? What do they need to consider when making this decision?
Yeah, and the answer is absolutely yes. We should be always thinking about that. And, we understand too that the real estate agent market, and first off, love my real estate agents. We work with over 300 individual agents and their associated precs. But what we know about agents is when we first get started, sometimes it takes a little bit of momentum to get going, right? So likely if we're just getting started, we want to be assessing whether or not a PREC makes sense. Here is the ultimate law for this, right? Because there's lots of different advice and different comments. Different accountants say, oh, you have to make $200,000 a year, or there has to be, your brother's cousin has to be working for you 3 days a week, or whatever it is. There has to be a specific rule in order to get incorporated. And we can throw all of that out the window. And I will tell you, we're looking for some consistency here and one message. The message is, if you're paying more than 12% tax in your personal life, then you should be considering a personal real estate corporation. So again, the answer is it doesn't matter what your revenue is at all. It's all about how much tax you're paying, because the reality is with a personal real estate corporation, we can fix tax rates up for the first net, not gross sales, net income at 12%. We can fix that tax rate. So if we're paying more than 12% personally on our tax returns, we should be considering a personal real estate corporation. And what I can tell you is that regardless of whether, you take all the money out and you spend it all, because that's always a consideration as well. If you're spending all of the money on whatever it is that you're looking, lifestyle needs, fast cars, whatever it is that you like, it's still okay. And you're still going to put about $5,000 in your pocket by having a personal real estate corporation. Again, that is if you're paying more than 12% tax personally. And what I can also tell you is the marginal tax rate on somebody who makes about $100,000 net a year is 30%. So, once we get to $30,000 of net income, we should be looking at a personal real estate corporation, depending on what other, personal tax credits you have. So for sure, this is a big thing. And I would say a secondary characteristic for you will be if you are looking at investing in real estate, not your principal residence, but if you're looking at buying any sort of real estate at all, you should have a personal real estate corporation. 100%. Because what
is
happens
that if you're an agent? Is that anybody?
That's if you can earn income inside a corporation and you're wanting to buy real estate, you should have a corporation set up. 100%.
A corporation, not necessarily a personal real estate corporation.
A personal real estate corporation only works for real estate agents, and it's a special corporation that's essentially the same as every other corporation, except it's more of an agreement. So the personal real estate corporation is a beneficiary of the work that the agent does. So in essence, we as an individual real estate agent have a job with a brokerage, and we get paid to sell real estate. Now, the personal real estate corporation is the beneficiary of your work. So it's slightly unique in how it works, that you're still the registered agent, but your corporation can get paid, and it is a legitimate sort of tax authority in that space. So if you are earning money and you want to buy real estate, we want to pay tax at 12%, and we want the business to pay tax at 12%. Then we have 88% after-tax money inside our personal real estate corp, or if you're not an agent and you have another corporation, for sure we should have that 88% there, and we can use that to buy our real estate or to make our investments. Now, I'll just say maybe one other piece with this. It could be investments that's not real estate. But the way that it works, let's say we make $100,000. Tax rate's 12%. We have $88,000 left. If you're an individual and you make $100,000, I told you the tax rate was about 30%. You have $70,000 of after-tax money left. 88, 70. If you can invest one of these two, which one's going to grow faster? Well, it's going to be the 88, right? So we want that 88,000 inside our personal real estate corp. That is our down payment money on our investments, whether it's real estate, whether it's index funds or stocks. Maybe you want to buy Tesla right now, whatever that is, you can invest that inside the corporation. Let's stop thinking about RSPs and pulling money out. Let's start thinking about leaving it all in as much as we can and reinvesting it in something that's going to earn passive investment income for us.
Love that. So then if I say, okay, I've got money in there and I want to pay myself, what's the best way to go about doing that? Should I be thinking salary? Should I be thinking dividends? And why? I mean, when, is there a certain limit that I should be staying within as well so I don't hit another tax bracket? Is that question?
Great question.
Did I jumble too much there together? That makes sense, right?
No, I know exactly what
cool.
you mean, and hopefully I can answer it nice and clear for you. So
I have a feeling you can.
I'm pretty good at this stuff, right? So here's my sort of assessment. It will always change, right? Every year where the federal government comes in and they propose a budget, and the provincial government comes in and proposes a budget, they're constantly changing tax rates and individual tax credits for people, for businesses. So we have to assess the situation every single year. So it might change from one year to another. If you're working with an accountant and they've been paying you salary for the last 20 years, you've missed out on some opportunity to receive dividend income, right? We should be altering this as opportunities arise. So what I would say for you right now is dividends are the way to go. Now, part of the reason dividends are the way to go is this nasty little Canada pension plan, right? As an individual, if I'm working for somebody and I'm getting my T4 employment income, they take off Canada pension plan contributions of about $3,000 from my personal paycheck, right? My employer also pays $3,000 to contribute to my Canada pension plan.
Don't get me started. Even though I walked into this one, like yes. That's a frustrating spot for me. Business owner.
Right?
Corporate taxes, HST taxes, CPP, employee taxes, income.
Everything.
Bob?
Everything, right?
It's too much. It's too much, man.
So I know it's too much. It's too much. So we can avoid this as a business owner. So if we pay ourselves dividends, we have no obligation to pay Canada Pension Plan. But if we want to pay ourselves salary, not only do we have to pay the employer portion, we have to pay the employee portion. So we're paying double the amount to put us on payroll, and we don't get any extra benefit related to that. So I don't know about you, especially you, David, but that really bugs me. And $6,000 a year is a lot of cash, right? Especially when they continuously move the Canada Pension Plan. It used to be 60. You could get it at 60. Now it's 67. What's going to be there when you're available for retirement? Is it going to be 75? Do we even live that long? There's a whole bunch of questions that really go into this. And my argument is I will take that $6,000. I will pay myself a dividend. I can keep that cash and I can put that into my account and reinvest it. But what happens when I have that $6,000? That's mine. It's not the government money. I don't have to wait for a certain period of time. I can use that $6,000 for anything I want right now. And the best thing is to leave it inside your company, start earning passive investment income. And, something happens to you, your kids can get it. Your spouse can get it, right? We own that money. Whereas the Canada Pension Plan, there's a lot more rules and regulations that if something happens to us to even get access to that money. So at a minimum, we're going to be able to save $6,000 in cash flow on an annual basis by paying ourselves a dividend right now. And the second, follow-up question that you had, because I'm keeping track of you, the follow-up question that you had was, is there a certain limit that we want to try and stay within? Now, if we're set up as a corporation, which I would highly advocate, right? Obviously, the tax rates are 12%. It's a great system if we can make it work for us. The more that we can leave inside our corporation and not take out, the more the benefit is. We still have a benefit, even if we take it all out, but the benefit goes up if we can leave money in there. Now, for me, if I'm making $100,000, I'm paying 12. I've got 88,000 of after-tax money in my company. I want to take out the least amount possible, because when we take money out, we have to pay personal tax. So if I take upwards of around 45,000, it changes from time to time, but it's somewhere between 42 and 45,000 as a dividend right now, we pay zero tax personally. That's a huge advantage. So if you can leave the rest in, and think investments, guys, right? Like we've got another $44,000 essentially sitting in our company account that we can invest. There's no more RSPs. If we contribute to RSPs, we have to take money out and then pay an RSP contribution. Leave it in the company. We keep our income nice and low. This is going to be a huge advantage for tax purposes. If you need to take out more, that's okay. We just want to maximize the amount that we leave inside the company, because that's when you're going to get your major win.
Okay, so what I'm taking from that then is you're better off doing the dividend than the salary, and keep the dividend that you take. You're very clear on that. I got you. See, when you're talking like save on taxes, I am listening. But as we talk about $42,000 to $45,000, if we take a dividend of 42 to 45K, we should be able to get enough where we can put the food on, cover the mortgage, do those things there, but we're also saving on the taxes, as opposed to taking that same amount of money as a salary.
Agreed. Now,
Okay.
There's a bunch of different circumstances that come in too, right? Like lifestyle is a big one. But I guarantee you that even if you pull all the money out as a dividend, you're still going to save that $6,000. So you're always going to be, again, understanding that our tax rate is more than 12% personally. We're going to save more money by having that personal real estate corp. We're going to save $6,000 at a minimum, even if we take it all out. Now, here's the other cool part, right? If we have a spouse that is also earning employment income or self-employed income or whatever, if they've already got an income level at a certain amount, we can actually leave all the money in, really. And we can put all the money inside the company if we've already got a spouse that's paying all the bills, right? So we need to look at this as a family and as a team to say, hey, if I can put all my money and leave all my money in there, aside from the 42.5 or 45,000, because we can take that out tax-free, everything else I want to leave inside my company so we avoid tax on it. And now with that, we're going to save all the investments inside the corporation. And if we're married or we're common law, guess what, everybody, half of it's theirs regardless. So it doesn't matter whether they're a shareholder or anything like that. Family law says anything that you've built together is 50% yours. So you can tell that to your spouse who thinks you're hoarding money. Nope. Guess what? This is half yours anyway. So let's use your money to pay the bills and your earnings to, pay for the kids' sports and the vacations and everything. We're going to consciously leave all the money in the corp, and we're going to save so much money together and build our wealth and our investments faster together by utilizing this corporate structure.
Okay, so then what if, and I'll just play off that scenario to say spouse is not generating income from another job, spouse was going to then take a salary or a dividend out of the corporation. Should we be paying both spouses as a dividend and stay away from salary? Do we say we're not going to pay both, we're only going to pay one?
Great question. I love it. So here, I guess what? $6,000 we're saving. Do we think we double that with two people? Absolutely. So now we've got $12,000 savings if we look at giving them each a dividend. Now, there's some income splitting rules that we have to be aware of. The Liberal government brought in a couple rule changes a few years ago that said we're not allowed.
We don't talk about the Liberal government.
I shouldn't have even brought that. I know it's a bad word, right?
I had to do it. Sorry, go ahead.
So they brought it in a few years ago that if we income split, we can't do it if the spouse is not actively involved in the company. So And the reason they did this is people like me were giving dividends out to family members left, right, and center, right? Anybody who had no income was getting that $45,000 because nobody was paying tax on it, including the kids. So they changed the rule. Fair enough. It makes sense. If we want to income split with a spouse, they have to be actively involved in the business to get a dividend.
One of our
Now,
Mindshare masters in our VIP room just asked about that. And forgive me to interrupt you there. Can you have a spouse on as a shareholder in the corporation? I think that's where you're going.
Yes. Yep, you definitely can. It's a bit of a sidestep, but we're good. We can have a spouse in the corporation, but they can't be an equity owner. They have to own a special share class. And if they own a special share class and they're actively involved, then we can pay them a dividend. So I'll jump back into what does actively involved mean? Well, as far as the Canadian tax authorities are representing, the spouse or anybody, any related party has to be actively working 20 plus hours a week, or they have to have risk associated with the business. Now, as a personal real estate corporation, there's not much risk in setting up a corporation. It's not like we're having to invest money to get it started. So that one's a little bit more challenging. But if we do have a spouse who's helping us with social media or administrative tasks, or even doing our bookkeeping or anything like that, if we can justify 20 hours a week, then we're going to be able to income split with them. Now, let's play devil's advocate for a moment. Let's say that that's a bit of a stretch. We can't get somebody working 20 hours a week, but are there any other opportunities for income splitting? This is where I would put a spouse or a family member on payroll. And let's specifically talk about our little kids here who are taking all the money from our pockets because they're so actively spending it on sports and education and birthday presents and all that good stuff. So one of the areas that we have an opportunity is to income split with our kids and with our spouses through salary. Again, assuming they're not actively involved in our business. Our kids who are under 18, we can pay a salary up to about $13,000 a year, and they pay no tax on that personally. Our business gets a deduction, and they pay zero tax.
How old do they have to be to start getting that?
So it's a great question. The rule says there's no age, but the rule says reasonable work and reasonable compensation. So depending on how capable your kids are or the tasks that you require them to have, they can be as young as you want and still contributing and delivering value to the business in exchange for salary. So I'll give you maybe a quick example there, David. I worked with a farm community out in Alberta quite a few years ago. And in there, they had a community where essentially they all worked together on the farm. And we had kids who were 8 and 9 years old who were receiving salary from the farm because they were actively out there picking potatoes, planting vegetables, watering the gardens, right? This was part of their community and that was part of their income source. So these kids were actively contributing and providing labor, and in exchange, we're getting that value. The beauty part, again, they get that money out, no tax paid on it. We get that deduction inside our business. It's a beautiful thing. No Canada pension plan if they're under 18 as well.
Okay, so then I got my 9-year-old and my 11-year-old, and they contribute with their own feedback and ideas. And then, Daddy, we don't like the logo. We didn't like your video. Maybe you should do this next time. Can I consider that, like strategic intelligence from my staff? And pay my 9-year-old and my 11-year-old?
So here's what I will say, right? I can't give you a definitive answer on this, but I will give you guidance to say, hey, if you feel like you're getting $13,000 worth of value from them related to that feedback, then by all means. They don't have an hour requirement. Here's what I do know. Family members have greater loyalty. We know that they're going to show up. They have secrets and access to information that others do not about how the business runs. They will work evenings and weekends. So there's some extra value attached to having family members. And I'll give you an example. My kids are 14 and 12 right now. My son is 14. My daughter is 12. My daughter, we're actually training her right now to do video and photo work, so that when I go do presentations at a town, she will travel with me and she will take photos and do video and send all of that info to my marketing manager to do cut up for social media posts and anything like that. So we're training her right now, and she's on salary because at 12, she's capable of recording a phone on a video on iPhone. She's capable of doing great quality photos on iPhone. She's going to be traveling and working. You know, what would you have to pay an assistant to go travel with you to New York or to LA?
Naturally.
That's a couple days of travel. You know, that's at least $13,000 if I'm doing that once a month. So looking at it and saying, how do we structure value that they're contributing in exchange for the money that they're receiving on the other side?
I like that. Okay, so as we continue the conversation around, you know, financial clarity and saving on taxes, there's a big misconception out there, and we've heard this one for years. But you know, I want to get to the bottom line. Like, what does this really mean? And then I want to figure out, you know, what constitutes and what doesn't. So when somebody says, "Hey, it's all good, I'll write it off," clarify what that really means for people, and then give some examples of what does and doesn't constitute a write-off. I mean, here, I'll ask you, like, should I lease my car 100% under my business?
It depends.
Okay. So first part of it, what is a write-off? What actually, and give us some examples,
Totally.
please, just so that we
Yeah,
can clarify what this actually means that you're doing, because it's not free. You still have money to pay.
you totally do. And I will clarify the vehicle question, because especially in the real estate space, that is an area that we get
Absolutely.
asked all the time. You know what? When you were saying that, David, it reminded me of, I don't know how many of your viewers will have watched Seinfeld, but
Yep.
many years ago, and a lot of my staff are younger than me, they didn't watch Seinfeld, but there was a clip in there where Jerry was talking about writing something off. And Kramer actually said, "You just write it off. The companies just write it off." And Jerry said, "You don't even know what that means." And Kramer said, "Do you?" And the idea is nobody knows what write it off means, right? Nobody gets that. But essentially, writing it off means that it can be deducted as a business expense, right? So we think of advertising, for example. You just write it off, write off a sponsorship. Well, right, it's got to be an income generating concept, right? You're putting money towards something that is building future revenue for your business or delivering on existing revenue. So real estate agents, your staging costs, your advertising costs, your administrative assistants, insurance, vehicle costs, anything like that, because you're essentially incurring those costs to generate business income, it is deductible as a business expense. It is a write-off. Now, here's one of the misconceptions that I get, and one of the questions I get all the time is, "But Bob, what do I spend money on to save more taxes?" And I usually joke, David, and I say, "Spend it on me. You know, that's a great way to save money. I'll take all your money and you can essentially get the deduction for it." But here's the reality, guys. And I do mean it though, like spend it on me. But
Yep.
if we go back to our PREC situation, the tax rate's 12%. So if we spend $100, we're saving $12 in taxes. We're still out $88 of that 100 on whatever it is that we spent money on. So I would rather pay $12 in tax and keep $88 unless it's going to make me more money in the future. And I think that's really, really important, right? So some of the things that we should be considering is, can we spend money on coaching and advertising and marketing and brand building that's going to build more, generate more revenue for us in the future so that we're making more money? Yes, we're going to pay more tax down the road, but I'd rather keep the $88 than only keep the 12 and spend it on something that is not necessary. So that's how the write-off piece works. Now, let me touch on, David, your question about the vehicles. This is a challenging question because it depends on everybody's situation. If you have a corporation, I would, and especially if you're driving a lot, right? Like real estate agents, you guys are driving a lot. So what I would do instead is the tax deduction for business mileage right now is about 70 cents a kilometer. So what I would do instead is I would charge a mileage reimbursement to my business at 70 cents a kilometer. Even if it's $1,000 a month, that's $700. I get a $700 deduction in my business, and I take $700 cash out of my business tax-free to pay for my vehicle expenses. Now, you guys are likely double, triple, quadruple that. So imagine $1,400, $2,800 you get a business deduction for mileage. You take that money out, you pay for your insurance, you pay for your gas, you pay for your, I was going to say license fees, but they got rid of those. Whatever other vehicle expenses that you have, you're likely making money off that transaction. So that's really the way to go. And from a risk standpoint, if the business doesn't own the asset and we're just getting mileage reimbursement, the audit risk is super low, right? There's no real mileage logs of how much you're using it personally or for business. You're just tracking the kilometers you're putting on for business use. It's a little bit easier. So that's a good idea. If you're not incorporated, likely what we're going to do is we're going to buy the well, we'll talk about that in a second too. Buy or lease the vehicle, and then we're going to claim a percentage of business use for that. So 70, 80%. If it's greater than 90%, we don't have to track mileage because it's completely deductible inside the business. You can do the same thing if you're incorporated. You can put that asset inside your PREC or inside your corporation, no problem. But here's the risk. If we're only using our vehicle for 50% business use and personal use, if the corporation owns this asset, we're essentially getting a personal use benefit from a corporate asset, which means we're going to have to pay tax on the use that we have personally. It wipes out the tax deduction, and now we're essentially at a wash. That's why when we start looking at corporations buying vehicles, it likely makes more sense to own it personally, unless it's being 100% used for business purposes. Buy it personally and charge mileage reimbursements. Now, the second maybe follow up on that, David, is do we lease it or do we finance it?
The word I forget. That's where I was going next. Now, is it a lease, finance versus the buy?
Yeah, so a lease or finance. So there's different tax deductions related to it. So a lease, essentially on a passenger vehicle, we get up to $800 plus tax a month as a deduction for our lease payment. If we finance it, we get up to $30,000 that we get to add as an asset and depreciate year over year the value of the vehicle. Now, if we're buying a car that's more than $30,000, there's a bunch of value in there that we can't deduct. But if we're using it personally, we get taxed on that full value. So there's double taxation area in there. So we want to be conscious of that. In an ideal world, if you were to lease for up to $800 a month and you go, well, man, I want that $50,000 car because I'm driving so much. That's just the luxury that I feel like I can afford. Extend your lease period out longer so that your payments come down to that $800 a month. That way it's fully deductible. On the finance side, again, you might get a higher deduction up front because we're depreciating the asset. But over time, we're not going to get a tax deduction at all for that vehicle because it's been depreciated so heavily. So those are sort of the two options. For me, I look at it and say, I'm not so worried about the tax savings on this. I want to worry about the cash flow in my business. Which one is going to cost me less on a monthly basis? That's the one I want to pay for, right? So if a lease saves me $150 a month instead of a finance payment, I'm going to lease because I keep that $150 a month and I can reinvest that in something that's income producing for me. So I always look back at cash flow because over time, the tax benefit's going to be pretty similar.
Okay, interesting. And so what I think I understood from that was if you have a lease payment around $800 a month, you can certainly do that 100% through the company.
Yep.
You got to pay attention to how much you're driving on a personal versus business. And that's regardless if your spouse does or doesn't have a car. You've got a car. What percentage is going towards business? If it's 100%, you can deduct it all. If it's not, you now have an extra expense there because there's some personal usage being taken out of it. I was going to also ask you about coaching, about marketing, but you've already answered that to say that all of those business tools, all of those go towards the tax deductible. Where if you spend money on coaching, you can, again, use the write-off. If you spend money on marketing for your business, you can again claim a write-off. Would that be correct? Just to reiterate that.
100%. And I love the write-off. But
Okay, cool.
and to your
Yeah.
point, you go, what better could you spend money on, right? Advertising and coaching, right?
Well, it's
Advertising to get
self-development
more
to make
lead
yourself
gen.
better. Right.
Totally. Yep. Advertising to get lead gen and coaching to get there faster, right? Get results faster than you would otherwise. So really, those are, for me, like the two best things that we can invest in. And team, right? Like team, if team gives you more capacity, we want team, we want coaching to get there faster, and we want advertising to get more leads and generate greater revenue.
So for everybody tuned in, and obviously it sounds very self-serving when I bring it up, but we are hearing it from Bob, and all jokes aside here from a very strategic perspective, yes, think about the self-development, think about the professional development you're putting into your business, think about the marketing that you're putting in. If you are looking to save or bringing the taxes down, again, think about what you can do to reinvest in you and your business. That will help you save on taxes, as we talk about that as a big topic today. Now, a common theme around tax season is that oftentimes a mad scramble right at the end, because again, oftentimes agents are waiting to the last minute to, sort of figure out what they owe, causing themselves to get into this mad scramble. So how important is it to set financial goals every single year, to be able to A, save money, be prepared to pay our taxes? And what steps, Bob, could you, suggest everybody, give some advice here that they could take to be more organized and prepared, both short and long term, for when the market does change?
Absolutely. Well, and first off, maybe I'll throw a question out and then I'll answer it, because it's not like we have a necessarily a live audience that we can engage with here. But how many
We've got
real
some
estate
people
agents?
that are locked in.
I see some comments coming through, which I love, but I'll answer it in the efforts of saving time. But how many real estate
Absolutely.
agents want to file their taxes June 15th? What's happening June 15th? Well, we've got the hottest market that we have all year and the most active buyers. Like, who the hell, David, wants to file taxes June 15th? Nobody. So
I don't want to
if
file
we're
them ever.
I don't know. I don't want to
Sorry.
file them ever either. And you listen, I do about 1,800 of them a year. So but guess what, guys? If we wanted to throw back one more benefit of setting up a personal real estate corporation, you can choose the year end of when you file your taxes. So pick September, right? You've got all your closings from the summer market. Closing right around September, you're going to be cash positive. You'll have to pay your tax bill by December 31st, but you're less active and you can pull those documents together. So, hey, let's choose that time of year versus June 15th, because June 15th sucks. So that's piece one. Second is, stop doing your own bookkeeping. Let's stop doing that. You know what? We've been hiring a lot lately, and we've been doing personality assessments. And I guarantee you, if I got the personality assessment review of a real estate agent, filing taxes and receipts is not going to be a career choice that you guys should be doing, right? Fair enough. The quality time that you have and your highest value is selling real estate. Let's get somebody to do your bookkeeping for you. That way, you get to the end of the year, there's no stress, no pressure. Everything is exactly where it should be. It's organized. Work with our team. We would be happy to do that for you. It's also imperative as a business owner for you to have up-to-date financial information to know how you're doing. So many real estate agents are spending marketing dollars. Yes, we get a deposit in, but we're maybe spending all that money on the next deal. How much money are we actually making? You want financial clarity in what's going on inside your day-to-day, because it gives you confidence to make good decisions. So we need to have that information available to you so that you know exactly what's going on and you can make the best decisions to make the most amount of money and plan for your future. Now, David, one more piece I'll add in there is one area that we focus on with our clients a lot is on financial literacy, but two, making sure that we're setting up an automated wealth accumulation plan. Because if we have all of our money sitting in our bank account and we're looking at it, that's essentially available for us to spend, right? And the reality is, as human nature, we like stuff. We like to spend that money. If it's sitting there and it's useful for us, we will spend it. So instead, what we want to do is create an automated plan that does not involve you It does not involve me. We don't want to be waiting on humans to make these decisions, but we set up a pre-authorized payment plan that takes money out of your business account and puts it into a savings or an investment account. I do this every single week, guys. You start out with a low amount, even $100 a week, which is $5,200 a year. Put $100 a week away. And next thing you know, you've got this little lump sum at the end of the year of $5,200 that's sitting there. Now, if you can put more away, great, do more. What I use this for is I build up, and my investment advisor hates this, but that's his problem, not mine. I build up this little pocket of money. And then when an investment opportunity like a real estate deal comes up for an investment property, I've maybe got $50,000, $100,000 that's sitting there that's been happening without me. And all of a sudden, boom, down payment, buildings financed, and now I've got a real wealth accumulator that's sitting there, and I've built a whole bunch of extra equity in my life just by having a forced savings plan. So for all of you out there, start that. You can do a self-directed pre-authorized payment every week. Get it going so that you're starting that wealth accumulation plan, because otherwise you'll end up being 70 years old and still living out of your bank account and not have put anything away for your retirement. So let's start now. The younger you are, the better it is, the easier it is to start with lower amounts. Get it as a forced savings plan. It eliminates the need for us to do anything.
So as we talk about planning and preparation and putting things away, and we talked about tax season, and tax is obviously a big topic today. When I get my big commission check, would you say it's okay to go buy that brand new BMW? Or is there a certain percentage of that money that you would advise me to be putting away off of every check so that I'm actually prepared when it comes to tax season? And if yes to the latter, is there a percentage that I should be thinking about just as a safety net for myself?
Yeah. So very first question, if you're getting big commission checks, set up that personal real estate corp. 100%.
Don't buy the BMW.
Don't buy the BMW. Here, like I love Grant Cardone. Grant Cardone and I have a lot of similar ways of thinking. We don't necessarily say the same things out of our mouth. But, you know, for him, he talks a lot about not spending money on assets that aren't income producing. And he's 100% right. You know, I watched a video of him one time drive around like a maniac off-roading in his $400,000 car. And he said, stop spending money on dumb things. And he drove his, I'm going to say it was a Hummer, over the curbs and back, and said, this is a dumb thing to own. He said, until you can accumulate enough investment income that your investment income pays for the dumb stuff, right? So if we have $100,000 and it's paying us $10,000 a year, we can use that $10,000 to spend on dumb things because we've accumulated wealth, and our wealth is paying for dumb things. Don't spend money on dumb things now. Spend money on income producing assets now. And then when they start producing enough income, then you can spend it on dumb things like the BMW, right? Listen, we all like a BMW, and it doesn't mean that you can't get the BMW, but let's be smart about it. If we're going to finance it or lease it, let's lease it over a 15-year period, whatever the hell they're going to let us do that for now, where our payment is $400, $500 a month. I'd rather do that than take $50,000 or 60 or 70 or 100 and put it down on this damn car. Let's keep all that cash in our business, get it invested in something that's earning income, and then use the income from that to pay for the car. That's the best way to do that.
Okay. Now, what about the amount that I should put aside from? Because I got you. I've heard you loud and clear. Don't spend on dumb shit. Fine. I'm with you. I'm listening to you. What would you suggest, though? Like if whatever the commission check be, let's talk percentages for a moment. Is there a certain percentage you'd say, hey, Dave, every time you make a commission, just take X, put it aside into a tax account that's literally just going to be there that I can say, okay, it's time to pay taxes. Bob, my accountant, says to me, David, you owe X amount of dollars. We go, Bob, account is there, grab what's needed, pay the tax man, see you later. And if there's any surplus, I'm going to take it back and put it back in my account, or I'll just leave it there for the next season. Is there a certain number, just rule of thumb? Is it 25%, 10%? Is there something you say to people that you give them some sort of advice on that?
assuming we're like a across Canada, maybe across the US sort of audience here too, David, because it'll kind of depend on the province.
Yes, sir.
Yeah. So,
Fair
if
enough.
we're thinking in Canada, we're thinking sales tax on commission. You have to understand whether you're an HST province or a GST province. So it's either 13 or it's 5 or it's somewhere in between. So if we're getting a commission check in somewhere like Ontario, where there's 13% tax on that, we have to put that 13% away. Maybe not all of it, but we should probably put 10% just to paying HST on that commission check. We also have to be conscious of the fact that we know we're going to pay 12% tax on that, assuming we're in a personal real estate corporation. Otherwise, it should be less than 12, because if our personal tax rates are less than 12, that's when we shouldn't have a PREC. But if we get higher than that, then it should be incorporated. So again, back to the tax rate, we're going to have all these write-offs and other business expenses and deductions that we have. We likely need maybe 5% of our revenue, of our commission check, to go towards a tax account as well. So 10% for HST. If we're a 5% province, we likely want 4% to go in there. And then for an income tax standpoint, we likely want at least 5% to go in there. So you're somewhere between, 5, 10 to 15%, 9 to 15% in there on a commission check. We want to make sure that that goes into a savings account, because we know that obligation's coming down the pipe. Now, it doesn't stop there though. So what I would do is I would probably, and some of the theory behind this goes, it's different between different people, but if you can put 20% of the remaining check into an investment of some sort, then that's probably a really great start, right? If we are getting a $10,000 check, we're going to put our 15% away, so $1,500. So that leaves us $8,500. If we can put $1,500 of that away into an investment every time that happens, we're going to be really starting off on the right foot and building an investment portfolio. And again, accumulating maybe enough cash to buy the next investment property that comes available.
Man, some great advice shared today. Absolutely, absolutely loaded. And I mean, I know there's a wealth of knowledge there from you that could go on into the smaller minutiae of every single one of these topics.
Sure.
The bigger question is this, and you mentioned this earlier. Focus on what you do. So as the realtor, don't be your bookkeeper. Have somebody who understands this. Very, maybe specific or generalized question right now. But how does one go about finding a really good accountant, the right accountant? Are there specific questions that people should be asking?
So do you just want to put my contact underneath here, David?
Well, we were about to go, like, how can people get a hold of you? Absolutely. Right. I mean, it's exactly that.
I'm kidding. Well, there's an easy solution there for sure. But no, one thing I would say, and regardless of, if you're a real estate agent or, if you've got a spouse that's also self-employed and they've got a business in their own area, you want to talk to somebody who's got experience and not just like a one-off, but deals with multiple people in your industry. And like I said, we deal with 300 plus real estate agents. It takes a large number of them to really see all the nuances of, pros and cons and ups and downs of different types of real estate agents, ones that are doing $50,000 a year in commission and others that are doing multiple millions, right? So we have a large variety. You want to work with an expert who's got a multitude of experience in your industry. So that would be one, because we're able to, when we have that specific sort of expertise and experience, give the right advice for the right individual inside that community. So that's really, really important too. I would definitely not work with somebody who isn't a professionally designated individual. A lot of the times, for a multitude of reasons, they could be good at what they do. But when you get into really starting to build wealth and really starting to get a business going, and you want to borrow money to leverage to build something greater, the banks are not going to accept it unless you're working with somebody who's got a professional designation, right? So we get a lot of time, people are going, oh, we're really frustrated because, the bank won't accept what it is that we're doing. Well, it's because we've got 20 years of experience and we've got an accreditation and we're upheld to certain criteria where other people aren't. So the banks can't rely on it as much. So, making sure that somebody's got the right designation and is a professional in the space, I think is really important as well. And you want to make sure that, they're available and open for business, because there's a lot of people in our industry, in our space, who are kind of capped and not really wanting to grow and just being a transactional sort of organization. You want to find somebody who's growing, who's going to grow with you, and probably who's not 75 years old and is going to retire and sell you off to somebody else. So, those would be a few criteria, David, that I would suggest. If somebody's looking, then you want to find the people who are active in the space, have experience, they're professional, and they're growing with you and giving advice as opposed to just being reactive.
Love that. Great feedback. So here's another question for you then. How do you know? And this is beyond, sort of the conversation we've had today. This is a lot more sort of directed to you personally. But how do you know it's been a successful day for you?
Great question. I don't cry. Listen, you know what? I have the great pleasure. So I've got a team of 48. So for me, the fact that my team feels supported and things are happening without me being involved, right? I would say one of the greatest highlights we send out client satisfaction surveys because we're always interested in our clients' feedback. We want to continuously improve. We're all human. People make mistakes. Sometimes deadlines happen and we've missed it or we've fallen short. We want to constantly improve upon that, right? And when I get client satisfaction surveys showing that we're, a 9.4 out of 10 from our 1,000+ customers, and I'm getting testimonials from people I don't know, and it's because of the team that we've created, that is a good day for me. The day that somebody I've never even heard of had the service level of a 10+ from one of my team members who's delivering exactly what we've created inside our business. And it's just embodying the culture of our business, and we're growing and scaling because of the service of somebody that's not me. That's a pretty good day.
Like that, man. Great answer right there. Very cool answer. So, Bob, give me some final words, some final tips here that everybody can use. All of our listeners, the entire audience, can get out there to help themselves build more mind share. And that probably goes down a lot of a marketing perspective, and where I come from the marketing aspect. That being said, there's just any final words of wisdom or tips based on anything even we talked about today that can help our audience progress in their day to day.
Yeah, David, I think you know this about me enough. We've connected a few times now that I'm very, very good with the technical. We can plan and schedule things out and help people accumulate wealth. And that's really the tactical side. But I'd love to maybe leave a note of what's going on in the economy right now and what's going on in businesses and in the market. And maybe not specific to real estate, but I think it relates, is that we all need to be very conscious that we're going through a time that's going to challenge a lot of people emotionally, fearful, right? The media is portraying the economy and the markets to be something that may or may not even, it might be a self-fulfilling prophecy, to be perfectly honest, right? Inflation is created, it's almost fictional, because the way that inflation's calculated is basing it on one period to another. And the comparison period is COVID lockdowns right now. So inflation is somewhat superficial, and essentially the market's being pushed into something that the media and everyone else is wanting to put it there. Now, I don't say that to just have a little bit of a rant. I think what the outcome is that there's going to be more opportunity for people like us sitting in the next 2 years than there ever has been. And I said this coming out of COVID, and I'm going to reiterate this now even greater, because so many people were kicked while they were down during COVID. And so many people are now getting this, PTSD of shortened economies, lower volumes, scarcity. And now we've got this second sort of tranche coming through of our economic recession that's happening. So people who have PTSD from the last time around are really fearful right now. So there's going to be people and a ton of real estate agents who are going, I don't know if I want to work that hard anymore. The industry's changing. We're going to get out of this, right? That's not anybody on this session right now, because people who are on this session right now are hungry. So if anything, I want you to know that there's a lot of people leaning back right now and watching what's going to happen and letting it happen to them. Now is the greatest opportunity probably in our lifetime to lean into the opportunity that lies ahead, to take advantage of it, because we can make so much money in the next 2 to 5 years. We can create intergenerational wealth in this period if we lean in and we take advantage of the opportunity that lies ahead. And I'm going to give David a little plug here, right? Because I wholeheartedly, and I'm a business coach too, but he's specialized in the real estate market, right? So for helping real estate agents get there faster, here's a resource that you guys have that can help you lean in and get there faster and capitalize on the opportunity that's going to lie ahead. Because guys, guess what? You are your greatest resource, and you have the greatest opportunity you will probably ever have in your lifetime in the next 2 to 5 years. So let's go get it. Hopefully, David, that works for you. I'm not affiliated with David in any way, but you know what? Experts like this help us get to the next level. And guys, I spend a lot of money on business coaches to help me get to the next level faster. I'm sure David does too. This is the way that we help make progress. Let's lean in when everybody else is pulling back. In fact, let's double down and really go for it.
How about, like Uncle G says, 10x this stuff, right?
Let's 10x this. You know what Uncle G said, and maybe I'll just throw one more thing out. A lot of times I talk about the business venture of being, 2 steps forward, 1 step back, right? Everybody deals with setbacks. Everybody deals with challenges. It's going to happen, right? We're going to have an upset customer because they didn't get the deal that they wanted. We're going to have a team member who doesn't want to work 41 hours this week, right? We're going to have setbacks, and they're going to happen. We can't eliminate them all. But Uncle G said the other day in his new 10X, whatever his new 10X book is, the 10X Mentor, I believe, is his new book. He said, the 2 step forward, 1 step back thing is actually, it's really, really real. We always feel that setback, but we're making progress. He goes, but who the hell says that we can only take 2 steps forward? Why aren't we taking 10 steps forward and 1 step back? Yeah. And I'm like, I like that, Uncle G.
Done. Words of wisdom, my friend. Words of wisdom. Bob, where can people find you? Because I want to lean in and really take advantage of everything you've got to offer when it comes to a ton of financial clarity.
Yeah. So again, we're an accounting, bookkeeping, tax, and legal firm. So we're essentially a one-stop shop. And if you want to check us out, our website is gauvreaucpa.ca. Any of our social channels are at Gauvreau CPA. Check us out, follow us. We're always trying to give great advice and add value to our potential clients, to our clients. So check us out. Happy to connect, see if I can add any value to anybody here as well.
I would say that it's right there for you. GauvreauCPA.ca. Make sure you check them out. Visit them on Instagram. Check out their website. Lean in to Bob and his team. I know that Bob, you've been doing some phenomenal stuff out there, man. I congratulate you and your team for all of the amazing success and the growth that you've had. And I want to thank you sincerely for making the time to join us on the Mindshare podcast today.
Thanks, my man. Anytime.
Stay right there with us. I'll be right back with you. Just going to sign us off. Once again, a big thank you to Mr. Bob Gauvreau. What an absolute amazing episode here today. Just a pleasure to talk. I mean, like I said, I had met Bob at the multifamily conference put on by our friend Seth Ferguson. An absolute amazing event. I'm going to give a little plug to the multifamily conference right now. Speaking of Uncle G, Mr. Grant Cardone is going to be there next year with us. So I want to encourage you guys, get your tickets. Check it out, the multifamilyconference.ca. Alex Rodriguez, former Major League Baseball player, will also be there. So it's going to be an amazing event. Be sure to check that out. But once again, a big thank you to Mr. Bob Gauvreau. I encourage you guys all to check him out. All that being said, you were either watching this recording, you were listening to us live, you're on iTunes, you're on iHeart, you're on Google Podcasts, Stitcher, Spotify, you name it. Maybe you went to my website, mindshare101.com, and on my site, make sure to download your free copy of the Ultimate Marketing Bundle for Realtors. This is a 90-day, it's a 31-page ebook with a 90-day social media content calendar in it. It's full of marketing, sales, tips, and tricks, all of it in an effort to help you build more mindshare so that you can get more market share. Also, talk about personalized one-to-one coaching, an in-person keynote talk for your next event, live virtual training, any type of mindshare experience. I want to encourage you, reach out to my team, connect with us. We are going to set up a free explore call with you, learn about what it is you're looking to achieve, and my team will work with you to figure out how to create a mindshare experience for you, yourself, or you and your group. So again, check us out. Make sure you just connect with us. info@mindshare101.com. Also, don't forget that our push to 100 is on. All you got to do is go to ratethispodcast.com/mindshare101. You can give us a big 5-star review, give us a nice little, tell us how much you love the show. We would be very grateful. Sincerely, thank you in advance. Also, if you haven't connected with me on Facebook, it's Mindshare 101. On Instagram, it's David Greenspan 101. So I look forward to connecting with you on any of those social media platforms. I want to take a moment here to thank Virginia Munden and the Buzz Conference for sponsoring today's episode. Be sure to visit their website, www.thebuzzconference.com. Check them out on Instagram @thebuzzconference, and keep tabs on all of the amazing events they're always hosting, including getting your tickets for the Disruption 2022 event taking place September 7th and 8th at the Liberty Grand in Toronto, Ontario. We look forward to seeing you there. Of course, I want to thank Kids Keep in Touch Systems for sponsoring today's episode. If you haven't checked this out yet, just go to my website, mindshare101.com, and click on Marketing. This has been another episode of the Mindshare podcast. Thank you for tuning in.